Hi, Peter Rose, Longwood Currency Trading. I wanted to chat with you today about a question that was asked of me, well, it was a while ago. It's about my 8-pip get out of Dodge stop point that I use. And the question from more than one person has been, God, 8 pips, man, that's just not very much wiggle room. There's some currencies that have an ATR that are 8 pips. I mean, you can't, pairs at the 5-minute level where I'm trading, I think it's the GBP AUD has, I think it's a 12 pip 5-minute ATR. So the question is, what the hell's the matter with you? Why are you using only an 8 pip stop? Why do you keep harping that in all of your videos and on your blog posts and all that other stuff? What are you trading where you can get away with an 8 pip stop without stopping out every 15 minutes? I trade pound dollar. I think that if you're going to trade, particularly in the beginning, you pick one currency pair and you learn all about that. It's like when you're trying to learn how to drive a car. You don't try to learn how to drive a shift car and then a regular automatic control shift, and then also try to learn how to drive a truck. They're different animals, so you got to learn one really well, and then if you want to go and drive a truck, you can get a CDL license and drive a truck. In trading, why trade more than one currency pair? You get to know that currency pair and you work with it and develop a sense for the economies that are represented by the two pair countries. And then what are you going to do? You're going to jump to another currency pair that has a little bit different characteristics. Price action is the same regardless of the time frame, regardless of the currency pair, regardless of the time of year. It doesn't make any difference. But your approach to trading it, how you feel about whether your entry point that you're considering clicking on is going to be valid. Is there enough momentum? You just have to get to know the currency pair. So I trade pound dollar and I use an 8 pip stop. Now, pound dollar on the 5-minute chart, you might have a 5-minute on a 5-minute chart may have a 5 pip ATR, 3 to 5, something like that. Don't I get stopped out a lot? And the answer is no, I don't, because I don't take the trade unless certain characteristics occur that give me a high probability of success that the trade isn't going to move 8 pips against me. If it moves 8 pips, I'm wrong. But get out. Why extend that stop to 15 pips? I mean, I'd still be within my risk to reward ratio of 1 to 1 or 1.5 to 1 or 1.25 to 1, something like that, reward to risk. But I don't have those. Those are meaningless to me anyway. I don't pay any attention to that. Either the trade's good and I'm going to ride it, or the trade's bad and I'm going to get out. And regardless of what the ATR is, don't take the trade if you think it's going to go against you. And you could say, well, geez, with an ATR of 5 or 6 pips, that thing has a high likelihood that it's going to get you. Well, yeah, if that's the way you trade, if you don't understand how to look at factors of momentum and velocity and what's happened structurally in the past, and what are the economies of the two countries doing at that particular time, answering those questions greatly increase the probability that when you step into that trade, you're not going to get your toes crushed, that it is going to go in your favor. Now, I was watching a video online today from some guys. I really like watching them, and they were talking about taking a loss for the previous week, and how that had affected their trading, and so they made the wrong decision to go in and take the trade, and they adjusted their stop, and they got taken out. That was a mistake. Well, yes, and that's exactly what happens. So you can't you can't take a trade based on your emotions, just like you can't close a trade based on your emotions. There are rules that you have to build your trading plan around, and you have to be willing to follow those rules. 8 pips, whether it's on a chart with an ATR of 3 pips or 30 pips, doesn't really make any difference. If the trade is going to go in my favor, it's going to go in my favor. If it's going to go against me, 8 pips is far enough. That's $8 1,000 risk. So you get $100,000. That's $800. Why would you want to take more than that? Why would you want to do swing trading or long-term trading where your profit target is 200 pips out, or let's just take it at 100 pips out or something? And then so you're going to expose yourself to a 100 pip risk, even a 50 pip risk. I mean, that's just crazy. If you trade a $10,000 account and you take a 50 pip risk, you're not going to be able to run that account very many times if you end up with the theoretical probabilistic 6 losses in a row. You're not. So look, you either know how to trade or you don't. If you don't know how to trade, then you shouldn't be worrying about the 8 pips is too much or too little, because you shouldn't be sitting at the table. If you learn your skill correctly, then when you're wrong, you want to get out. And I keep harping that and harping that and harping that. So I hope this answers the question of why I use this 8 pip stop. I mean, sure, if you're going to trade pound AUD with a 12 pip 5-minute ATR, you may want to give it 12 pips. You may want to give it 15, because that means that your profit target is not going to be where mine is, which is 13 to 15 pips with a hopeful target of 20. But your profit target is going to be out there, I don't know, 30 or 40 pips. So you take a 15 pip stop or a 20 pip stop and you got a 30 pip target. Yeah, well, you can do that based on the numbers. I just don't like to hope that my momentum calculation right now is going to be strong enough to take that price 30 pips. I'm not even confident that it's going to go the 20 pips or the 20 or the 15 or 20 pips that I have, that I say, well, it's got the juju to go to these 20 pips, so I'm going to be able to get in the trade. I don't even trust that. Look, I've been looking at currency markets since 2007, and and I lost my money in the real account when I did, because of all the reasons that I've given in the past. Putting too much money in and over leveraging. Those are 2 main things. Also being just stupid about it, because I listen to all these people on YouTube. I'm just another person babbling away on YouTube here. But I'm telling you that regardless of where your profit target is, if you're taking more than 8 or 10 pips risk, you're just going to be killed. And look, current best practices say an reward to risk of at least 1-to-1, and most are saying 2-to-1 is the way to go. Well, let me tell you what, if they're all saying that, boys and girls, then why is it that 90% of the traders lose 90% of their money in 90 days or less? Why is that? Because they follow these stupid fucking guidelines that are not applicable to the real world. That doesn't mean that you can't take more risk when you're going for more profit, but there are other factors involved. You can't just have a static rule that says do X, Y, Z, have a reward to risk of 1.25 or 2-to-1 or whatever it is. You cannot do that. There's other ways of approaching it. What I feel are better ways. And I wish I could tell you I've made zillions of dollars in it, and there's the proof. I didn't. I lost my money because I listened to these videos and I read these books, all these great rules. Look, I come out of a real estate investing background, and there are static rules that you need to follow. Why I didn't pay attention to the fact that those rules have corollary rules to them that will shade your decision process as to whether you're going to buy the property, whether it's time to sell it, whether you're going to charge more rent or not. There's all kinds of factors involved instead of just saying the foundation is good, the roof is good, the electrical is good, so it's a good buy. It's not a good buy. There might be, like I said in a previous video, a pig farm that's going in a quarter of a mile away. You just have to take everything into consideration. That doesn't complicate trading. That I'm saying take everything into consideration. All I'm saying is look at it like a chess game. Here's the board. That's all the information that you have. You don't have to worry about whether that guy was a world champion or whether you had a bad day or whatever yesterday. The board gives you all the information about the game at that particular time. Make your decision based on what's going on right there. Are you going to sacrifice your queen or are you not? That's the decision you need to make. So, you know, trading is a skill like everything else, but you cannot go into it with these folks saying, you know, here are these best practices rule. Best practices for who? Ask yourself that question before you follow these guidelines and things. I'll probably address this in some other videos as we go along and try to drill this out a little bit more, give you a little bit more detail in it. But for now, I'm going to go enjoy the rest of my day. It's June 18th and 2020, and I'm going to go finish out, have a cup of coffee, finish out my day. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.